Most people hear about central banks in the news, but very few understand what they actually do. Central banks do not run businesses, sell products, or serve everyday customers. Their main role is much simpler. They manage the conditions under which money exists and moves through the economy. By the end of this video, you will understand what central banks are, why they were created, and how they influence borrowing, inflation, and economic activity without directly controlling people or markets. Let's start with why central banks exist. Before central banks, banking systems were unstable. In the 19th and early 20th centuries, financial crises were common. Banks failed frequently, money shortages appeared suddenly, and economic activity could stop when trust disappeared. Countries created central banks to provide stability, institutions designed to support the banking system during stress and help manage the overall money supply. Today, a central bank sits at the center of a country's financial system. Commercial banks interact with households and businesses, but commercial banks interact with the central bank. One of the most important tools a central bank uses is the interest rate. An interest rate is simply the cost of borrowing money. When borrowing becomes cheaper, people and businesses are more likely to take loans. When borrowing becomes more expensive, fewer loans are taken. Lower interest rates generally encourage borrowing, spending, and investment. Higher interest rates generally slow borrowing and reduce spending. Because banks create money through lending, changing interest rates indirectly changes how much new money enters the economy. This means central banks do not usually create most money themselves. Instead, they influence how much money commercial banks create. Here's a simple way to think about it. Central banks control the environment. Commercial banks create money within that environment. When interest rates fall, loans increase. More loans lead to more deposits. More deposits expand the money supply. When interest rates rise, borrowing slows. Money creation slows as well. Central banks also use another important tool called open market operations. In simple terms, central banks buy or sell government bonds in financial markets. When a central bank buys bonds, money enters the banking system, increasing liquidity. When it sells bonds, money is removed from circulation. Sometimes during periods of economic stress, central banks purchase large amounts of bonds to support financial stability. This process is often called quantitative easing. The goal is to keep financial systems functioning smoothly and maintain stable economic conditions. All of these actions are aimed at balancing two important objectives: stable prices and stable economic activity. If money grows too quickly, inflation can rise. If money growth slows too much, economic activity can weaken. Central banks continuously adjust their tools to manage this balance. What makes this important is that these decisions influence everyday life indirectly. Interest rates affect mortgages, business loans, savings returns, and investment activity. Even though most people never interact directly with a central bank, its policies shape the financial environment around them. Understanding central banks helps complete the picture of how modern money works. Banks create money through lending, but central banks guide the pace and conditions of that creation. In the next video, we will connect another key piece of the system, government debt, and explore how borrowing by governments fits into the modern money structure. Each step reveals another layer of how the financial system operates.